Okay, so fast forward. Now we're 29 years into the future. How are Tom and Ben doing? Tom's been working hard to keep up with his plan to self-insure, as he called it, since his term insurance was about to expire the very next year, and he had had some health issues come up. He's not sure he's going to be able to afford to get another term life insurance policy. Now that he's older, it's way more expensive. And although his original plan was to have the mortgage paid off, the mortgage is not even close to being paid off. He had to get a cash out refinance, and he also has a home equity line of credit on his house to pay off some of the home repairs to help his kids get through college as well. So, his credit card debt is still hovering around $16,000, and his car loans are still pulling at him at roughly $1,000 a month from his monthly earnings. He even had to take a loan against his 401k for about $40,000 to come up with some major medical expenses that weren't even covered by his health insurance. Tom says that things would have been different if he had just seen the last two market crashes coming. If he had just gotten out of the market in time, he would be in a much better place. He looks at his actual returns, and they're not much better than the average investor over the last 29 years, which is about 3.6%. And that's before taxes are factored in. So he's hoping just to get out of his 401k the money he originally put in there all those years ago. His kids are also unfolding into an interesting story. He didn't see the cost of college growing at 7%, double the rate of inflation at the time, and his 529 plans also got slammed by those same market crashes. His oldest kid graduated the same year the markets took a 50% nosedive. So Tom and his wife had to take out Parent Plus loans to help pay for their kids' expected family contribution. That'd be the money that the college expects he and his wife contribute to help his kid go to college. He was irritated at the nerve of those financial aid counselors. Can't they see how much debt Tom and his wife are in? He and his wife finally finished paying off their student loans only 5 years ago. Maybe he shouldn't have gone back to school to get that $70,000 graduate degree. He didn't even get a promotion at work. Of course, they've really thought of just draining their brokerage account, but after Tom saw those major market corrections vaporize his account value, there's not much in there now anyway, and he really hopes for a major market comeback to make all of his retirement dreams come true. His 401k doesn't even allow for in-service distributions while he's still employed at work, so that's trapped in money he can't use. Speaking of his 401k, because of all the debt he's been servicing, he had to pull way down on his contributions, down to the 3% match, since he's having to service so much debt, and he's still trying to sock away for the future. He'd like to do a lot more, but he just can't. Too much month at the end of the money, he says. He's proud of his 401k balance, though. He has a whole $104,000 saved up there for his entire retirement. He'll even have more there once he's paid back that $40,000 loan. So he just did a calculation, and he'll be able to afford about $310 a month from his 401k to live on. Well, that's not as much as he thought. On the other hand, Ben has had a very different experience with his financial life. Ben now has 6, count them, 6 specially designed Bank on Yourself policies. 2 on him, 2 on his wife, and 1 on each of his adult children now, with whom he started his policies back when they were still in diapers. Because the cash in his policies is liquid and available to him, he's been able to use the cash for various financial needs and pay himself back on his terms. He's used policies to purchase 5 cars. He's used policies to fix the roof on their house. And when he had some medical expenses, right around the same time Tom did, that his health insurance didn't cover, he just used the policy to pay for them. No big deal. The policies have remained a constant source of capital for investments as well. A few years ago, he dipped his toe into the waters of being a landlord. He used his policy to buy a rental property, and his timing could not have been better. It was during a major real estate market correction, or as he called it, when everything was on sale, and banks weren't lending to other competing buyers. So he almost just named his own price. It's all because he had started those policies over the years, and he had the forethought that he might need cash available someday. Now this rental property has been a help in paying back his policy loans and supplementing his income needs. Now his kids just graduated college, and they're paying mom and dad back. Why would Ben require his kids pay back their student loans to the bank of mom and dad? Besides teaching them the value of education and of a dollar, Ben knows that every dollar his kids pay back is going straight to him and his wife for their retirement. And then to his kids' inheritance. I mean, it is life insurance and there is a death benefit after all. So he's planning on gifting his kids the policies he started on them as a kiddo when they get married someday. He really just can't wait for that great gift. Now, speaking of retirement, Ben recently did some calculations and found that he'll likely be able to take about $120,000 a year in income tax-free money from his policies. He knows this with a high degree of confidence and certainty because his policies are not tied to the stock market or real estate markets, and there's even guaranteed increases in the cash every single year. And he isn't concerned that some outside force, like a market crash, could tamper with his nest egg. He has no investment or advisor fees in his whole life policy. And every single year he pays his premium, at this point it's guaranteed to grow by more than the money he's put in that year. I mean, it feels great. His policies had expenses, yes, those first few years. It resulted in a negative yield early on, but those were years that are far and gone now. And he knew 25 years ago when he started these policies that he'd have a minimum guaranteed net worth as of right now, today. The returns have been slow and steady. After all things are considered, somewhere in the middle single-digit range. But to Ben, that rate of return is almost an afterthought. He's been able to overcome the problem of opportunity cost, the problem of either spending money on things he needed today or saving for his future. For Ben, it's not either or, it's become both and. So what's the moral of the parable? Do you want to be Tom or Ben? If being average means being Tom, then I don't want to be average. Instead, I want to be like Ben and use Bank on Yourself. Bank on Yourself policies grow compounded and guaranteed every year. There's no years like the stock market where it tanks. It keeps your money liquid and available for all of life's emergencies and opportunities. It gives you the chance to overcome opportunity cost when you need cash because it keeps on growing even on the capital you borrow.